From chapter 1, the most important thing is summary of management assertions categories. This is the most important thing. So today we're going to spend a little bit more time on those one. And again, the role of authority is to test the management assertion about the classes of transaction events for the period under the audit. How he can do? He's going to chase. The auditor is going to chase first for the occurrence. Occurrence means transactions in an event that have been recorded or disclosed have actually happened. And such transaction events pertain to the entity, not only happening, but is related to the entity. Next thing is they're going to chase for the completeness. What that means? That means that all the transaction events that should have been recorded actually have been recorded. And all the related disclosures that should have been included in the financial statements have been included. Then the auditor is going to check for the authorization. Authorization means all the transaction events have been properly authorized. That's very straightforward. He's looking for the authorization that somebody actually authorized. Next one, accuracy. What means accuracy? For the level of assertion on the transaction events. Accuracy means amounts and other data related to the recorded transaction events have been recorded appropriately. And the related disclosure have been appropriately measured and described. Then the cutoff. Cutoff means the transaction events have been recorded to the correct account period. Then we're going to classification. And what classification means is that transaction events have been recorded in the proper accounts. So is it recorded for the proper accounts? We're going to chase through the classification. Cutoff is for the correct period. Classification for the correct account. Presentation means the transaction events are appropriately aggregated or disaggregated and clearly described, and related disclosures are relevant and understandable in the context of the requirement of the Global Financial Reporting Framework. This is for the transaction events. Now let's see what's going to happen with the accounts and the balances. Assertion about accounting balances and related disclosures again at the period end. First, the auditor is going to chase for the existence, means the asset, liabilities, and equity interests exist. Second will be rights and obligation. The date, that means the entity holds or controls the rights to the assets and the liabilities. And liability such as the obligation to the entity. So basically we're chasing, is it actually, if it's asset, is it actually, no, is it not the asset, but is it actually, we have actually control over the asset? And if it's liability, do we have actually obligation for that liability? Next one will be completeness. Now completeness, as you can see here, we have completeness. And here we also have a completeness on the transaction events. But completeness here is that all the assets, liability, and equity interest that should have been recorded have been recorded. Same thing with the transaction events, but now we're going to the assets and liabilities as elements of the financial statements. And all related disclosure that should have been included in the financial statements have been included. Then we're going to the accuracy, valuation, and allocation, where in the transaction events we have only accuracy. Now here we have accuracy, valuation, and allocation. Asset, liability, and equity interest have been included in the financial statement at the appropriate amount, and any resulting valuation or allocation adjustments have been appropriately recorded, and related disclosure have been appropriately measured and described. Classification. Here we also have classification. Here we're talking classification is for the proper accounts. Here the classification is the assets and liability and equity interest have been recorded in the proper accounts again. So there's an overlap between those two. So at least less for you to memorize here on the classification. And the last thing is the presentation, same thing like presentation here. Presentation for the account balances means the asset, liability, and equity interests are appropriately aggregated to the or disaggregated and clearly described, and the related disclosures are related and understandable in the context of the requirements of applicable financial reporting framework. I'm going to keep going repeating those assertions that auditor is going to look for until the end of this course, so we can get familiar and you understand everything that the audit is going to look for in terms of the transaction events and in terms of account balances at the end of the reporting period. Next thing important from this chapter was the audit reports. And the type of the audit reports that we have during the audit, we have audit ends up with unqualified opinion, qualified opinion, adverse opinion, or disclaimer. Those are the four available options that we have. So now let's see the first one, unqualified opinion, when the auditor finished the audit with unqualified. Unqualified audit report is the main product, obviously, of the audit. And the standard unqualified means clean audit report is the most common type of that report issued. In this context, unqualified, now that what means unqualified again, means that because of the financial statements, free financial material misstatements, auditor does not find it necessary to qualify his or her opinion about the fairness of financial statements. Next option is qualified. Now, see when the auditor is going to issue qualified opinion about the audit. So that will be, suppose the auditee financial statement have contained misstatement, and the auditor consider it material. Tell the managers to fix those, and the manager refuse to correct the mistakes. In that case, auditor have to issue qualified report. The other option that when you look with qualified report is, or auditor is unable to get sufficient appropriate evidence regarding the specific accounts. Here we talk about the assertion about account balances at the end of the period is not met. So auditors will likely qualify the report, explain that the financial statements are fairly stated except for the misstatement identified by the auditor. Next one is the adverse opinion. Now that's, in this case, the company under audit, financial statements contain a misstatement that the auditor considered to be material that is pervasively affect the interpretation of financial statements. In that situation, the auditor will issue first opinion. In that case, as you can see here, is we indicating the financial statements are not fairly stated and should not be relied upon. The last one is the disclaimer, that probably is the worst. And if the scope of limitation is so pervasive that it limits the ability to the auditor to conclude on the financial statements whole, the auditor will issue disclaimer of opinion, indicating that it's not possible to express any opinion on the fairness of the financial statement. So those are the options. This is from the chapter 1. Now from chapter 2, stop sharing this. For chapter 2, that was a very, very informative chapter. However, explain the environment of for the auditors and that type of the audit that we have, and going over the type of services that the auditor can provide to the clients. What's the duties of certain members of the audit team? What's happened with the audit in terms of who from where the rules are coming for the audit. The most important thing from this one is the model of the business that the auditor needs to know that, and also the organizations and the different organizational transactions which happen in the process in the company. Now there are 1, 2, 3, 4, 5 processes in the company. One is related to the revenue. Always starts with revenue. Then we go into the financing process. Then we go into purchasing process. Then we go into the human resource management process. And then we end up with the inventory management process. Once we have all those processes in the company, basically we cover the company. The other thing that was here, the organization that affect the audit in Canada and which will apply for the on the international level. You need to know both of those. And who set up the audit standards in Canada and on international level. What else was important here? Pretty much that's all. The rules for the professional conduct, we said that those rules is going to come when you actually see become a CPA student. Then you're going to have access to the rules of professional conduct, and from there you can see the rules. And I already told you that I'm going to print some material. I'm going to give you the materials, and I'm going to start giving you something from next time. So you're going to have extra materials for you to study. Now for chapter 3, what was interesting for chapter 3 was we start doing the audit planning and types of the audit test and how we're doing the materiality. Now we're jumping directly to the audit. And again, there are 2 scenarios for the audit. Either we're going to deal with the new client, either we're going to deal with the existing client. Once we're dealing with the new client, we have to assess 3 things. Do we have the capability to perform the audit? Is there compliance with the legal relevant ethical requirements? And we have to see, well, how's our integrity of the client. And capability means, do we have a technical skills? Do we have enough people? Do we have the experience? If you need to hire specialists, can we find one? And can we meet them in reporting deadline if we have that engagement with the client? Next thing that we have to consider is how independent we are to the entity that we auditing, and can we accept the entity without violating any applicable regulations. The last one was to consider integrity with the clients, means to identify the business reputation of the client, the nature of the client operations, indicator that the client may have inappropriate business, and if that's happened, obviously we have to decline them. Now, once we do that, once we evaluate the client retention, and we have to do that periodically, we're close to the audit, we have to complete, or after significant, we have to check with the conflict over the accounting and audit issue and dispute over the fees. But that's for the continual clients when we start with, if we have a continued client. In preliminary, we have engaged audit activities during the audit and preliminary activities which are from the time during the engagement. First, we have to determine what kind of audit we do. Then we have to set up the engagement team. Then we have to follow the requirements. And then we have to assess our compliance with the ethical and independent requirements. Now, how are we going to establish understanding with the entity? First, we're going to prepare this engagement letter. We're going to using the work of the internal audit function, and we're going to find the role of the audit committee. Engagement letter will be the arrangements if we need to use a specialist, any limitation of the liability of the auditor's client, additional service if we have to provide something additional, and any arrangements regarding to those other services. Thus, everything has to be communicated in the engagement letter. Then we have to check the internal audit function. How objective is, means can we rely on the internal audit? There's any internal audit. How competent the people who's doing the internal audit are, and how systematic and disciplined they are during the process of the internal audit. And here we're going over the objectivities of the internal audit function and completeness and systematic disclosure approach. Those are very specific, so I want you to pay attention to all of those. During the planning of the audit, we have to come up with the audit strategy, which is more broad, and we have to come up with the audit plan, which is more detailed. Auditor will develop the overall audit strategy for conducting the audit. And the auditor then will develop the audit plan, which will be more detailed than the audit strategy. Technically, that will help you to the auditor to conduct the engagement in effective and efficient manner. So we want to be effective at the same time to be efficient, not to waste too much time and money of the client. Now, the step that should be included on the planning stage is first to identify the business risks. Second will be not in that order, but to establish the materiality. Consider if there's multi-locations, how we're gonna deal with that. Assess the need of specialists. Do we have enough knowledge? Do we need something? Is there any evidence that we need some help from the outside specialists? Then we're going to consider the violation of law and regulation, if there are any. The related parties, which are the related parties, is there actually a related party? Consider additional value-added services if we have to provide the access services to the client. And we have to document everything. And then we're going step by step how we're going to assess the business risk. By understanding the entity and in the environment. Why do we need to do? Because once we identify the business risk, that may result in material misstatement. So basically, everything that you think is risky, it can affect the materiality. And then we have to evaluate how entity responds to those business risks. There was a chart, if you remember. Let me see with that chart here. This chart was kind of help you to go with the business objective and strategy as identify the business risk, check which assertion that relates to, identify the audit risk, what's the control function in the company, if there's any, and the last one will be what will be the effect on the audit plan. If the company, once we identify the audit risk, and if the company proves that they actually have internal control over that risk, we don't need to, on the audit planning, we don't need to put a lot of procedures here. We can rely on everything that has been done inside the company. But if the company don't have control procedures, their internal control doesn't exist here. In order for us to reduce the audit risk, we have to put a lot of procedures, and that will affect our audit plan. Those are different value-added services which the auditor can provide to the client. Those are important because those services require different report, which is not audit report. So during the audit test, we're gonna document the nature, the timing, and the extent of the audit. Now, type of audit tests that we can have is the risk of assessment procedures, tests of the control, and substantive procedures. Not gonna spend time to explain those one again. How are we gonna test the control? We're gonna inquire appropriate management supervision. We're gonna inspect the documents. We're gonna observe the application of those specific controls. We're gonna read perform of the application of the control by the auditor, and we're gonna do the walkthrough on certain documents, in this case invoice, tracing, in order to confirm that the transaction originate from the transaction level all the way to the inclusion on the balances at the end of the period. Now, this is the example of the internal control and how we're going to test that control. Now, the substantive procedures means that we're going to test the test of the details and analytical procedures. That means we're going to test for errors and fraud, individual transactions, account balances, and disclosures. For the individual transaction, we're going to apply the level of assertions for the transactions. For the account balances, at the end of the period, we're going to apply the assertions for the account balances and for disclosures altogether. Analytical procedures will be evaluation of financial information through analysis of plausible relationship among financial and non-financial data. That's on analytical level. On analytical level, what we can do is we can use even artificial intelligence at this level. There's a dual purpose test of the control and subtesting transactions, and that brings the dual purpose of the test. Materiality. Establishing materiality is very important through the stage of the planning of the audit, because that's going to give us idea how deep we're going to go the audit planning and what kind of procedures we're going to put through the stage of the audit planning. First, we're going to determine the overall materiality, which is the planning materiality. Then we're going to determine the tolerable misstatement for the individual account class of transaction. And then we're going to evaluate the audit findings, but that will be at the end of the audit to confirm what we found. Is it material? Is it not material? So the first one with the overall materiality, remember the overall materiality is related to the effect on the outside users of the financial statements. Tolerable misstatement, that will be performance materiality, will be how confident we are that there's no material misstatement, or if there's material misstatement, we can, as auditors, we can live with. And the last step will be at the end of the audit to evaluate all the findings and see. On the determination of the overall materiality, I want you to remember there's obviously there will be standards, either Canadian or international standards, that's going to give us which benchmark, quantitative benchmark we can use for the establishment of the materiality, overall materiality. But the general rule is first we to go with the income before income taxes. If that's not appropriate measure, then we're going to go with the total assets. If that's not appropriate, we can go with the total revenue. If that's not appropriate, we're going to keep going. Now, to what will be the percentage of those? Those percentages are given on the international accounting standards or in Canadian standards. In the standard specifically says that if you're using the income before income taxes, materiality can be between this and this percentage. Then we're going to have the quantitative amounts, which may be adjusted for the qualitative factors. If there's any material misstatement from the previous years, we might consider that amount. We're going to assess the risk, potential the low covenants violation if we sense something during the planning stage of the audit. Small amount again can cause the entity to miss forecasted revenue and earnings. An entity operates in a volatile business environment. Now, if the entity has a covenant over a specific asset account, let's say there might be requirements or the entity to keep certain amount of inventory as a part of the covenant, then that might be trigger we to choose for the benchmark actually total assets rather than income before income. The tolerable misstatement is again tolerable is the amount of the planning materiality allocated to the account and classes transactions. That tolerable misstatement would be greater than the planning materiality. Why? For all those reasons. Again, we want to feel as auditor, we want to feel comfortable before we sign the audit. And the last one is to evaluate. And when the audit evidence, we start gathering those evidence, we're going to see what's the aggregate misstatement for each account. We're going to consider the effect of misstatement not adjusted to the prior period. Compare with the overall materiality, and if the aggregate misstatement is less than the overall materiality, then we can conclude that the financial statements are fairly presented. If not, adjustment should be made. That was from chapter 3, materiality probably, and how we're going to go through the process of materiality is not the most important, but the very important part. Okay, that's with chapter 3. Now let's move to chapter 4 and let's see what's happened with chapter 4. How the chapter 4 was for the assessing the risk. Now, why do we need to assess the risk? Because the risk is going to determine what will be materiality and what we're going to do through the planning stage of our audit. So, how are we going to assess the risk? By understanding what kind of risk we have. First is the audit risk. Audit risk is the risk that the auditor express inappropriate opinion when the financial statements are materially misstated. So basically, we issuing a unqualified report when they're actually misstatement of the financial statements. What is the risk of that? So assertions level, we're going to change the assertion level for the financial statement level, individual account balances disclosure. Now, on the risk model, as we said previous time, there's inherent risk, control risk, and detection risk. Inherent risk, that's related to the business of the company. Control risk is the risk that associated with having some procedures in the company which are followed by the internal auditor in the company. And detection risk is the only risk that the auditor can use to reduce the audit risk during the audit. That's the only option that the auditor actually has. So the formula for the audit risk was inherent risk time, control risk time, detection risk. Now, detection risk is the non-sampling risk or sampling risk. What is the risk if we don't do any sampling, and what's the risk when we do the sampling with something? So for the simplicity, we're gonna combine the inherent risk and control risk, and we're gonna label it as risk material misstatement. And then we have the detection risk. If the risk of material misstatement is high, that means our audit procedures will be very high in order to reduce the detection risk. So we don't want to miss anything. So that means for that reason, we have to actually see everything. And that's it. Once we do that, then we're going to reduce the audit risk. We issue something that it's not there. Engagement risk. Obviously, that will be what if we accept client when appropriate business, or we don't have the capability to do the audit, or we're missing specialists. Then we're going to expose ourselves to the financial loss and damage of our professional reputation. That's potential the engagement risk. On the audit risk, again, model, how we're going to find what will be the detection risk simply by dividing audit risk divided by the risk of material misstatement, or inherent risk times the control risk. And that was the chart with how we're going to adjust the risk. Relationship with the business's risk model, that will be first we're going to assess the entity business risk. Then we're going to relate those risks to what can go wrong on the account balances, knowing that this risk exists. Then we're going to assess the risk of material misstatement or inherent risk type control risk. And that's going to help us to determine where will be our procedures in order either to keep the detection risk low or keep it up in order to achieve the audit risk that we have during the planning stage. What's the limitation of this model is that it's a planning tool. The model only is good as the judgment and assessment used as inputs, correct? And desired level of audit risk may not actually be achieved through this model. Yes, we may want to reduce the audit risk, but we might not be able to achieve. Now, on the process, on the risk assessment process, that will be auditors perform the risk assessment procedures to obtain the understanding of the entity and the entity environment. Second is understanding. By doing this, we're going to help us to have understanding and identify the business risk and understanding potential misstatement if may have. And then we can consider the responses to the entity, of the entity to the business risk related, and how this leads to the audit to assess the risk, material misstatement of financial statement. This is the chart overall for the audit risk assessment process. First, we're going to perform the risk assessment procedures. We're going to set some inquiries about the management and the other people. We're going to put some analytical procedures, including the audit data analytics, and observation inspections will be the procedures that we're going to put in order to get more understanding about the entity environment. What that will include: the name of the entity, industry, objectives, entity performance measures, internal control procedures, if there are any. Now, once we do that, then we're going to identify the business risks that may actually affect the financial statements and can lead to the material misstatement. Once we do that, we're going to evaluate the identity risk assessment process. What and how management respond to both business risk, and then evidence of implementation. So basically, we're going to check, is there any procedures in place at the company to assess the process and how the management actually dealing with those. Then we're going to assess, trying to stay on the chart here. Don't believe this is the chart. This is the chart here. And then we're going to evaluate that we already did that. The last thing left is to assess, make it smaller and move it up. Last thing is to assess the risk of material misstatement of financial statement and the session levels. So that's why it was important. It's important you to know all the session level. Where actually the risk gonna be? Is it gonna be on the occurrence? Is it gonna be the existence? Is it gonna be on the cutoff? Where exactly it's gonna be? And which one is related to the transaction and events, and which one is related to the account balances at the end of the reporting period. Now, how are we going to gather the evidence? Again, we're going to do some inquiries to the management and in other personnel, and even we can go to the outsiders. For example, for accounts receivables, how are we going to check the existence of the accounts receivables, and actually what will be that will be the more likely occurrence. That will be through sending the confirmation letters or asking the client to send the confirmation letters to the accounts receivable clients, which they're gonna send a letter directly to us auditors, not to the company, and company forward to us. That's not the proper procedure. So basically, we're trying to eliminate the entity. It's pretty much the same thing that sometimes the school asks you to do. Yes, I want you proof of your diploma, but I want the institution that issued that diploma to send it directly to me. Same thing the auditor is doing through the audit. Just want to make sure that everything is correct. Analytical procedures, we can put some analytical procedures. Analytical procedures will be by having all information in one place. Obviously, the auditor is going to ask for the other information. It's going to put it in some software, which software is going to start doing some tests, and we're going to start doing, is there any deviation from the regular amount that's happened under each account? And if we see some irregularities in the amount, we're going to pull those transactions, and we're going to start chasing of the occurrence, existence, cutoff, and all the other session level. The other one will be observation and inspection. Observation, what that means in observation, that means that as soon as the auditor step in the company, he starts to observe. Means we start observing from the security. Is there any security in place? Once we step in the company, what's the level of the security? What's the business environment? Is it friendly? Is it unfriendly? All those things can tell us and can help us within the stage of planning the audit. And then obviously we're going to start doing inspections in the place. So understanding the business, again, let's repeat everything. First, we're going to find about the nature of the entity. What industry works, that industry that the entity works, is there any special regulations? And is there any external factors that may affect or not affect the business? Then we're going to check, is there internal control in place? What's the entity objectives? What's the entity strategies? What kind of business risk we can identify in the company? Business risk is related to the business and the nature of the business and the business environment, which most of the time company has very limited ability to affect those risks. They just exist. And entity performance measures, obviously, we may have a quantitative, qualitative measures here. Then, now to understand the nature of the business of the entity, and the auditor should tell about the entity's business operation. How can we do that? By chasing the revenue sources. What's the nature of the revenues? From where the revenue comes from? Are we selling the product? Are we selling services? Are we in the manufacturing? And what's the market? The conduct of the operations, alliances, joint ventures, outsourcing activities, location of the production facilities, warehouses, offices, where is the if we're a mining company, where the mining actually happen? Is it happening in Canada? Is it some mine in Africa? Where exactly is? The key customers. Is there any key customers? Is there anything that the company rely upon? Is there any customers which holds, let's say, 20% of the revenue? If it's more than 20 or 25% of the revenue, once you split all the customers, then you can find out which one is the key customer, which one is not. Is there any customers that company rely upon? Because if something goes wrong with that customer, that can affect the company. And important suppliers, if there are any important suppliers. If one company supplies more than 50% of the company accounts payable, so presents more than company accounts purchases, that means they have, it's called, in some instances, it's called alpha vendor or alpha supplier. Means it from the management account perspective, that's good to have that kind of alpha vendor because you can establish a relationship with that alpha vendor. But on the other hand, you start to relying upon that alpha vendor to a greater extent, which later can increase the business risk in the company. Ownership and the governance structures, who is the owners, what's the structures in the company, how they structured actually. That's what we have to do as auditors. Investments, investment activities. Is there any investments that currently company have? What's the current investment activity? How they invest? Are they aggressive or not too aggressive? Where they actually are? How they diversify the portfolio? How does investment disposition of the securities and loan happens? Do we have any capital investments activities? That's going to help us to understand how the company planning to work in the future. Nature of the entity, also financing and financing activities. So basically here we can go through simply over the cash flow. As you can see, those activities that we're chasing here are part of the cash flow statement. First, we have the operating activity, then we have the investing activity, and then we're going to have financing activities. We can to some extent, this, how can I say, those activities are identified through the cash flow statement. And a financing activity, major subsidiaries and associated entities. What's the debt structure? Is the company relying more on debt rather than equity or vice versa? Leasing arrangements, is there any leases in the company? If there's any leases, then we're gonna see during the process of the audit what kind of level of assertions we're gonna chase here on the leases arrangements. Related parties, derivatives, financial instruments, if there's any. Financial reporting will be the accounting principles. Industry-specific practices. Is there any industry-specific practice which are not applicable to any other clients? Revenue recognition practice, when the revenue is recognized. There's different level for recognition of the revenue, so we have to find out where exactly on which point the revenue is recognized. Accounting for the fair values, how the company comes up with the fair value. Accounting for unusually complex transactions, we have to have understanding about all those different events that happen in the company. Now, on the industry regulatory other external factors, industry conditions is the market, again, competitors. Is it a cycle? Is it seasonal? What exactly is the activity that happens in the company? Product technology related to the entity products, energy, supply cost. Regulatory environment is the accounting principle industry specific to that particular company. Any regulatory framework for this related industry on which the client is in. Legislation, regulations, taxation, what kind of taxes this company has. Is it the corporate level? Is it on the partnership level? What exactly is government policy currently affecting the conduct of the entity business? Environmental requirements. Other external factors can be general economic conditions. Where is the industry right now? And when the client is in, is it under recession? Is it under growth? Where exactly is interest rate and the ability of the client to obtain financing, and inflation and other currency revaluation, if there's any. So as you can see, in order to understand the business and the business environment, in order to assess the business risk, we have to gather all this specific knowledge which is related to the company under the audit. Now, objective strategy and related business risk. We have to identify and understand again entity objectives. What's objective? What the entity wants? What's the strategy to obtain those objectives? And what's the business risk associated with the objectives and the strategy applied by the company to obtain the objectives? Now, internal control. Internal control is important part of the assessment of the entity because of internal control is going to help us and going to give us idea how extensive we should go on the procedures that we're going to put in order to reduce the detection risk. So internal control, what we're going to do to understand and assess the effectiveness of the internal control. Now we have to identify the type of potential misstatement and the factors that affect the risk of the material misstatement first. That we can achieve through the first stage, understanding the business, identifying the risks in the company. And it's also assist designing the appropriate audit procedures. So if the internal control again exists, then we can put less procedure in place. That will reduce the time that we have to spend in the client site, and obviously we're going to reduce the fee for the claim. Assessment of the material misstatement. Now, Errors can happen unintentional, and then we're going to have unintentional misstatement. Or we can have intentional, and that will be fraud, which fraud is refers to an intentional act by one or more among the management or people who are charged with the governance, employees, and other third parties involving the use of deception that result of misstatement of financial statements. Anything that may lead to the misstatement of financial statement, it's going to be intentional. Example of misstatements will be inaccuracy in gathering or processing data from the financial statements on which the financial statements are prepared. Second one will be omission of the amount or disclosures. Just simply decide not to include that amount or not to disclose something. Financial statement disclosure that are not presented in accordance with general setting accounting principles. Now, what that means that if the company has to apply accounting standards for the private enterprises, they decide to use cash basis accounting, for example. Incorrect accounting estimate, which happen for the overlooking or clear misinterpretation of facts. And judgment of management concerning the accounting estimates that are already considered unreasonable or accounting policy that already considered inappropriate. So if the company still applying for the inventory and calculating of cost of goods sold, for what will be that last in first out method, which is not acceptable, that will be a red flag for the auditors. Now, fraud and fraud involve intentional, which is involve intentional misstatement, can lead to fraudulent financial reporting or misappropriation of the assets. Misappropriation of the assets, that will involve of theft of the entity assets. That will be basically stealing of the assets or paying for goods and services not received by the company or embezzling cash received. So those will be examples of the misappropriation of the assets. Again, when it comes to the fraud, chase the cash and anything related to the cash, because don't forget which is the easiest asset to be misplaced or be used for some other purposes rather business purposes for the people who work in the business. That will be cash. If the company eliminate the cash completely and access to the cash completely, that will reduce the level, reduce the risk of misstatement. And then we have to chase the other assets. If we have a golden mine, a gold mine, and in that case, the item that will be, the asset that will be under stealing will be the inventory, in other words, the gold. That will be the one. So that's why you have to understand the business, and by seeing the business, you have to be able to assess the business risk and to see from where the potential of the material misstatement can come. Fraudulent financial reporting, that will include acts such as following: manipulation or misclassification or alteration of accounting records, or supporting documents used to prepare the financial statements. So we may have a fake invoice, or we may just simply ignore some of the invoices. Mispresentation in or intentional omission from the financial statement at the level of the transaction or significant information. And the other one will be intentional misapplication of accounting principles related to the amount classification matters of presentation and disclosures. As you already know, the accounting principles give you a lot of options if you can use them correctly. And that's going to happen usually through the adjustment entries at the end of the reporting period. We as auditors, we should know those things. And then apply appropriate procedures to make sure that those are actually not there. The fraud risk identification process, including first source of the information, which possible this discussion among the audit team. Then the next one will be requirement to the management and the others. Analytical procedures, investigation of the unexpected period end adjustments, and identification of the fraud risk factors. I don't know, I can't remember, I believe we talk about fraud. I don't think we talk about fraud here, but I can't remember which course we're talking about fraud. In order for fraud to exist, there have to be three elements. First one is the financial pressure. Second one is the opportunity. And then comes the act of the fraud. So if you eliminate, you cannot know the financial pressure of the person who committed the fraud. And that's something that it's very hard for you to know, because that's maybe something personal, which may be available as information after the fraud happened. But opportunity is the one that the internal audit control can eliminate. And we as auditor, we should advise the internal control or the internal auditors to be more cautious and to see the opportunities which are presenting to the person in terms of access to the assets, or have access to the journal entry, or have access to the collection of cash and the recording of accounts receivables, invoices, and cleaning those invoices and depositing money in the bank account. And that creates opportunity for fraud. So fraud risk triangle, actually there's three conditions usually exist when the fraud happen. First one is the incentive for the pressure of the preparer. So now let's put everything on the company level. Now imagine this, the company has covenants and they have to maintain the current ratio of 2. We're doing the financial statements. We only prepare the financial statements. The management will prepare everything before the auditor comes, and they check the current ratio. They say that the current ratio currently is 1.9. Now, I perfectly know that if I don't do something about the current ratio of banks, if the bank or the auditor comes, he audit the reports, and he confirmed that my current ratio is actually 1.9, bank is going to call the law. Now I have the pressure. What I can do about it? Looking for the opportunity. What will be the opportunity? Well, I have access to everything. I'm the management again. So what I can do some tricks here. You know the accounting policies. I can play with the long-term assets. I can flip the long-term assets into the current assets, and that's going to affect my current ratio. Or, if you remember from finance course, what I can do is I can simply use the cash to pay my accounts payables or clear my accounts payables close to the end of the period and improve my ratio, since my ratio is already above 1. So if I use my cash to pay my account payable, that's gonna, but that's not a fraud in that case. That's simply understanding the finances and how the effect on the current ratio is. But we're talking here about something else. Here I can, how can I flip the long-term assets into the current assets in order to be included in the current assets formula, and that's the way to manipulate the current assets or the current ratio. Well, that will be something very simple. Now let's go to the attitude or rationalization of to justify the fraud. And that will be, I'm going to ask the accountant or maybe I'm going to ask the manager to pretend that I'm selling some of the assets. So temporarily to put them in the to record them as the financial statements as asset for sale, available for sale. And once they become available for sale, then they're going to be classified as current assets. The only thing that they have to do is to meet all the 6 requirements for the accounting to reclassify and put property, plant, and equipment into the assets available for sale or held for sale. That's the only thing that they have to do. Now, if I support it with the proper documentation, then that will be very, how can I say, very hard to find from the auditor. But if the auditor already suspect that my current ratio is, I have a comment on the current ratio, which is more than 2, and my current ratio is currently just a little bit over 2, that means something might go on. And then the auditor has to put the appropriate procedures and he to realize that, hey, there might be a potential misstatement here. So let's check this accounts and find out what exactly happened there. So that will be the example of the fraud triangle. Again, we have the opportunity, and we have the incentive, then we have the opportunity, and then we have a realization. Once those 2 exist, pressure or incentive and opportunity, realization is very, it's just a matter of time. Risk factors which are related to the incentive or the pressures is the excessive pressure management to meet the third party expectations. In this case, in our example that I give is the bank has requirements for the certain current ratio. Financial stability and profitability are threatened. Well, if I don't meet the current ratio, again, the bank's gonna pull out the recall the loan. If that happened, I may be in big trouble. Management personal financial situation is threatened. So of course, management's personal financial situation is threatened because if I bank the pull out the loan, then I won't have enough cash to pay the next payroll, for example. Now, the fraudulent reports for the opportunity is the nature of the industry or entity operations. Sometimes if my accounting is on Excel spreadsheet, obviously I have the opportunity to do whatever. Ineffective monitoring of management, or management is not concerned with monitoring the transactions. That might be a sign of fraud. Complex, unstable organizational structure. Very complex or unstable organizational structure can be evidence of opportunity and deficient internal control. If there's a deficiency within the internal control in the company, that again creates opportunity for realization of the fraud. And next one is the fraudulent financial reporting risk factors related to the attitudes reasonable, including the non-financial management's excessive participation in selection of accounting principles and estimates. If that happens, most likely there's something going on. Excessive interest by the management in the share price and earning trends. Obviously, we can easily say why the management is so obsessed with that earnings per share price. Committing to aggressive or unrealistic forecast. So that will be another evidence that can give you a clue for what the risk potential misstatement. Ineffective communication of ethical standards or selection of inappropriate ethical standards. Recurring attempt to justify marginal or inappropriate accounting based on materiality and history of violation of the securities law or allegation of fraud. If that happens, obviously we have a problem in the company. And we as an auditor, we have to see those things, not only identify, we have to see them. Again, we're talking about the incentive, opportunity, and realization. Let's see this. Which of the following example of the fraudulent financial reporting? Have a look and let me know what you think about this. Again, we're checking about example of fraudulent financial reporting.
I think A.
A. Yes, A will be the right one because that's the only one related to the financial reporting. Everything else is the fraudulent, but that would be fraudulent activities, which is related to specific transactions in this case. For example, this one is a very, very, very common thing. An employee borrows small tools from the company and neglect to return them. That's a very, very common thing. It happens pretty much every day. Employee goes to work. The office provides office supplies in terms of pens or markers or anything like that, or something like a sticky notes. The employee grabbed a package of sticky notes and bring it home. One of the kids liked the sticky notes and start sticking it all over the wall, and the employee doesn't return that one to the office. That's a very, very common thing, and it happens to pretty much everyone. Is this fraudulent activities? Technically speaking, it might be. Now the fact is that going to affect the audit? Well, technically it should, but in reality, this is the amount of those sticky notes is not material. Yes, there will be to some extent material misstatement of financial statement, but that misstatement will not be material. Now, the sticky notes not going to be used for the purpose of the business, it's going to be used for the purpose of sticking them on the wall at home. I know it's a silly example, but this thing happens. The process of the responding of the risk material misstatement and how we're going to design perform the audit procedures. This one is the important thing. Once we find the risk of material misstatement, means that inherent risk and control risk are very high. That means we have to perform audit procedures in order to reduce the detection risk. So, how are we going to deal with this? Let's go with the first one first. We're assessing the risk of material misstatement of financial statement assertion level. Financial statement risk and assertion level risk. Then we're going to start asking questions. Do those risks relate pervasively to the financial statements? If the answer is no, then we want to determine that what might go wrong at the assertion level. If the answer is yes, then we're going to develop the overall response to that answer. Now, if the answer is no, then we're going to determine what might go wrong with the assertion level. Now, assertion level, that's why it's important for you to denote assertion level of risk related to the transaction events and account balances at the end of the reporting period. We're going to start seeing those assertions more and more and more and more at some point. That's why it's very important for me you to know those assertion levels now, so you can understand the whole audit process. Then we're going to design the audit procedure for the assertion level risks, which we identify if there's no financial statements levels. Now let's go to the auditor response to the risk assessment results. Now, once we get the results, the response appropriate to the risk statement level risk, auditor may do the following. First, assign more experienced personnel or those with the specialized knowledge. If I find out that the inventory count actually matters, I'm not going to send my junior auditors to do the inventory count. I'm still going to send them, but I'm going to make sure that there's at least one or two seniors auditors in the group of the auditors who's going to do the audit count. I'm not sure if you know the normal practice, but apparently this is the practice which happened even today. I was talking to one of the owner's daughter. She was auditor. I'm not sure if she's still working. Probably I believe she moved to the industry now. But when she was a student, she started with PricewaterhouseCoopers, I believe. But anyway, it was company Big Four. She went for the audit at the year end in Africa, one of the countries in Africa, and she explaining to me the practices that currently people doing we're talking about no more than 2 or 3 years ago, which are the practices that we were using when the audit team comes for audit in 1998, 1999. Yes, on that time, I was constantly exposed to audits. 1990, that's the way I get my all my knowledge about audit, because the auditors literally slept in the company when I was working as an accountant. So basically, that's how I develop all my knowledge, and I know all the things that they're doing, and I know how they're doing it, and that helped me a lot later in my late years as an accountant. Because I always prepare everything that auditor needs before they even ask me for. But anyway, that's relevant. The point is that the techniques that we were using to trick the auditors during the inventory count are used even today. So you would think that with the technology and the evolution of the humanity is going to change those principles. They haven't changed. Sadly, they haven't changed. That's why I started when she told me what they're doing, I started laughing, because that's exactly what we're doing back in 1996, 1997, 1998. So basically, what's happening here, what I'm trying to tell you is this. I'm not going to give you the example. Now, I was working with the company where the inventory count was very important at the end of the period in terms of inventory count, not of the we had a lot of materials that we use in productions. So raw materials was one crucial inventory count. The other one was the working process. The working process was quite substantial amount. And the last one is the finished goods or finished production at that time, and the scrap. So what we're doing is, I know this is recording, but anyway, I'm going to tell you so you can understand the whole process. When the auditor comes in the company, we had a main gate, metal gate with the security there. So the financial director clearly instructed the security guard, which is in that metal gate, if this and this and these people from this company come, we know they come in. If they come, you not let them in. In the contrary, you're calling me and telling me that they're there, and I'm going to send a person who's going to get them and bring them in the company. So what was important at that stage is we to identify who's coming, what's their age, what's the mix of the people. Is it more female or more male? What's the age? Those are the important things. And then we're responding to whoever comes, responding in the appropriate way, to reduce their level of efficiency and awareness. So basically, if you see a gentleman coming, from the company side, you're sending the young girls to support with their audit. So basically, those young girls, I'm sorry that I have to tell you this, but those young girls are dressed appropriately for the event. So those young gentlemen, when they come, they have to pay more attention to the girls rather than to the inventory what they count. And that's how we get the results that we wanted to get. Now, knowing this, that was my surprise, because my owner's daughter told me that they're still doing exactly the same things. First, when they come to the audit, they bring them to the room full of drinks and food and everything with the people to entertain them. And after that, they're supported with the young gentlemen in this case to respond to the nature of the auditors and try to make them less efficient and less aware of the inventory count. Because because once the auditor says inventory count is done and that junior auditor signed the report, we have a signed confirmation now and balances, which is official. Now, what's the risk of material misstatement? That's the interesting part. Then, so we're gonna assign more experienced personnel. So by knowing that, what we're gonna do, we're gonna assign more experienced personnel on this specific code task. We're gonna evaluate the selection of the application of the accounting policies to identify earnings management or bias. And we're gonna incorporate additional elements of the unpredictability in the selection of the audit procedures. Again, that's gonna, I don't expect you to understand all those things right away, but one day when either become auditor or either you're gonna be exposed to audit, I really hope through your life we're gonna actually be exposed to audit and to see what actual audit means. I know if you end up working in a private company, the highest level of assurance that you're gonna see will be compilation, which is, oh, what can I say? That's not audit. That's not even 5% of audit. It's just a review, basically. And who is responsible for that? That review that is done by the auditor, but who, if there's any misstatement, who is responsible? Management. That's a management responsibility. The auditors are clean. That stays on the. I promise I'm gonna show you the that engagement letter from the company that I'm working, and I'm gonna show you next time when we're in the class. So I'm gonna see what exactly is written on the engagement letter. Now let's go with the evaluation of the audit test results. In the completion of the audit, auditor should consider whether the total misstatement caused the financial statement to be materially misstated. If that happened, then now we are on the position what kind of report to issue. If we cannot gather enough evidence, obviously we're going to go with the adverse opinion. But if we have the evidence and if we ask the managers to change and fix the mistakes and they then refuse, then we're going to issue the qualified report. But if we find that mistake and we find that the financial statement materially mistake and we tell the managers and then they fix it, then we have to issue unqualified report. Now, if the financial statement, so in the completion of the audit, whether the total misstatement caused the financial statement can be material, then what's going to happen then? If the financial statement is materially misstated, the auditor should first request manager to eliminate the material misstatement. If the manager agree and eliminate that misstatement, then there you go. We're going to issue that unqualified report. But if the manager does not make a need adjustment, then the auditor should issue qualified or adverse opinion. Now, what's the difference between qualified and adverse? Qualified issue, if you remember, yes, there's when the management refused to change, we're gonna say that yes, the financial report states. but there's some material misstatements. On the adverse opinion, now the point is that we don't gather enough evidence. Once we gather enough evidence, we cannot express our opinion. Is there a misstatement? So we know there's a misstatement, but how big is the misstatement? We don't know. Now, if the auditor determined that the misstatement is or may be a result of fraud, and it has determined that the effect of could be material, the auditor should first attempt to obtain audit evidence to determine whether, in fact, material fraud has happened. And if so, it's effect. Consider the implication of the other aspects of the audit. Discuss the matter and appropriate further investigation with the appropriate level of management. That is at least one level above those involved in the commuting the fraud and with the senior management. Now, this is kind of important in terms of if you find a material mistake, something that is not appropriate, then you're not talking to that person at all. You're not talking to people from that level at all, because most likely they're all involved and they know what they're doing. Now, the question is management aware? Because sometimes that misappropriation or misstatement can come directly from the manager. Well, if that's the case, the only thing that you can do as an auditor is just follow the rules and issue the audit reports, which actually reflect the situation in the company. If that has to be adverse opinion, you should adverse opinion. Is it qualified? You should get qualified. But don't forget, most likely, the people of the same level, they'll be all involved in whatever channel. Now, the question is the management is also involved? Because most of the cases, some of the cases, not most of the cases, when there's a financial pressure on the company through the covenants, that that fraud can come directly from the management. And management can actually guide the people who have to do it and tell them what exactly. I was witnessing one place, which was very interesting case, where the company hiring employees through the recruiters, and the employees hired in the company to sign certain documents, which documents are kind of how can I say, those through those documents were actually misappropriation happened, and that misappropriation leads to the financial misstatements on the financial reports. Unfortunately for the company, the employee which was hired kind of identified that, and the employee went to the manager, and the manager said to the employee that you have to sign those reports and you have to sign those documents. And the employee said, but I have to tell you there's something fishy going on with this, and the way it's written, that's material statement here. And then the manager became anxious and said, that's why you hired for. Either sign them, either resign from the company. And then the employee went to the recruiter, back to the recruiter, which is the biggest recruiter here in Vancouver. And what happened is something that is not very, how can I say, I don't want to use the word nice, but not very appropriate. The recruiter said to the this employee, which was become now former employee, because as soon as she refused to sign those documents, the company just let her go, and she has to resign, right? And the recruiter actually later on said, when she explained all the situation to the recruiter, they actually said, well, we're gonna stay loyal with the company because that's our biggest client. So there's nothing we can do about this. And my guess at that point is that they hire another person for the same position to do the same job that the previous person find out that that's not appropriate and resign for that reason. But I can probably guess that the recruiter find another person who went there and signed those reports. And after signing those reports 3 months later, I can clearly tell you what's going to happen with that person. It's going to be released from the company. But again, this is something that happens. So you have to be careful as an employee. You have to be careful as an internal control person. If you end up with internal control, you have to be aware as auditor that these things actually happen. So that's why it's important you to attempt to obtain audit evidence to determine whether in fact material fraud has happened and it's in effect. You have to consider the implication of all the other aspects of the audit. Discuss the matter with the appropriate personnel. Suggest that the appropriate level of management consult with the legal counsel. And consider withdrawing from the engagement if you think that this thing is involved in the higher level. Don't forget, we as auditor, we always have an option to withdraw from the engagement. Now, the documentation that the auditors for the risk assessment, auditors should document discussions among the engagement personnel. That's why there's some minutes of every meeting. Which minutes of every meeting you may able, when it comes to the CPA, once you see the audit cases, most of the information is going to come from the discussion or the meeting between the senior and the junior auditor and what they found in the meeting. Procedures performed to identify and assess the risk of a material mistake due to the error and fraud. Fraud risk or other condition that result in additional audit procedures. The nature, timing, extent of the procedures performed in response to the fraud risk, identify and result that work, and the nature of communication about the error and fraud made to the manager, audit committee, and any others means counselor on that. So that's why it's important everything to be documented in the case that you suspect that there's a material misstatement and that material misstatement is related to the fraud. Communication about the fraud, whether the auditor has found evidence that the fraud may exist, the matter should be brought to the attention again to the appropriate level of management, which usually is the highest level. Fraud involving senior manager and fraud that causes material misstatement financial statements should be reported directly to the audit committee. Now the question is the audit committee involved as well? Auditors should reach an understanding with the audit committee regarding to the extent of the nature of the extent of communication and that misappropriations or disclosures of the fraud to the party other than client is the client senior management, and the audit committee originally is not part of the audit responsibility. So do you clearly understand this? We are not there to if the let's think about it. If the auditor find during the audit that the client's doing something and fraudulent activity, which fraudulent activity causes a reduction in the GST, on the GST amount that the client pays to the government. Now the question is, does the auditor have to inform Canada Revenue about this? And the answer is you don't have to. Now, again, the disclosure of the fraud to the parties, other than the client's senior manager and the audit committee, originally is not part of the auditor responsibility, and originally will be perceived, played by the auditor, ethical or legal obligation of confidentiality, except for the following conditions. So we're not disclosing anything outside, because again, it's not ethical or legal or legally obligated, and because of the confidentiality, to comply with certain legal or regulatory requirements. Now the question is that GST part of this? To a successor auditor, when the successor makes inquiries and procedures auditor about the client. So basically, if we are the new auditor and we asking the previous auditor about something that we suspect, the previous auditor should disclose that with us. In response to a subpoena and to a funding agency or other specified agency in accordance with the requirements for the audit or entities that receive governmental financial assistance. So those are the instances in which we may have to disclose whatever we found during the audit, which might be fraudulent. Again, for the GST, the example that I tell you, we have to see, is this actually falls under this to comply with certain legal or regulatory requirement? Is it that part of the case? If that's not part of the case, then we have to maintain our confidentiality and ethical behavior. That concludes this chapter 4. Again, it's very interesting chapter, but for the assessing the the risk. As you can see, risk assessment and how we assess the risk in the company. Now I'm gonna give you a little break, and then we're gonna start with chapter 5. How do you feel so far? Give me some idea on how do you feel so far? Are you okay?
Yes, Prof.
How do you find this? How do you find this all this risk assessment part? Sorry? I mean, honestly, guys, I really hope you're gonna go on the audit so you can actually see what the auditors do. And you'll be surprised how they collect the information these days. I'm not sure if I told you, but I think I did. But I'm sorry if I have to repeat myself. Again, I have this student from Douglas College last semester, which I was he was doing co-op. I was his officer from the college, which assessing the co-op. So I had to go there and interview his manager, and had a very interesting conversation with the manager there. And the way they gathering the information or about the company and how they're assessing the information is very, 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 I don't want to say the very super high level, but it's very advanced these days. They even using artificial intelligence to do that analytical part, so they can come up with the irregularities in the client if there's any. So it's very, very, very interesting. So I really hope you're going to have opportunity to see the whole process. Okay, I'm going to give you a short break and we're going to continue in 5 to 10 minutes, if that's okay. Are you okay with that? Are
Yeah,
you guys for
sure.
the
Yes.
are you guys for the break or you want me to continue? How do you feel? Do you want me to continue or you want break?
So, just in my case, just continue. It's okay.
How about the rest of the people? You want me to continue or you want short break?
To continue, Prof is okay with me.
Continue. Okay, let's go there. Let's continue. Let's go to see now how we're going to gather the evidence and how we're going to document those evidence. That's now, once we assess the risk, once we get the client, how we're going to deal with the rest. So let me share my screen and keep going with the evidence and documentations. All right, so let me see if we're still recording here. Okay, so evidence and documentations. So first we have to see the relationship of the audit evidence and how gathering those evidence can affect the report. We're going to see the financial statements, right? The first thing that we're going in the company, first we're going to see the financial statements. Once we see the financial statements, we're going to have this management's assertion about the components of the financial statements. Then we're going to assess the risk. We're going to put the audit procedures in place. Then we're going to provide the evidence of the fairness of the financial statements through the audit procedures. And gathering the documents, gathering the evidence and everything. Then we're going to reach conclusions based on the evidence, conclusion based on the materiality and the risk of the materiality misstatement, and then we're going to issue the audit. This is the part that we have to walk through, starting with the financial statements and issuing the audit report related to the financial statements by saying, yes, those financial statements are correct. No, those financial statements are not correct. Or yes, those financial statements are correct, but they might be a potential misstatement, which will not affect your opinion. So again, we're going back to the assertions level. Assumptions about the classes of the transaction events and the related disclosures happen with the occurrence, completeness, authorization, accuracy, cutoff, classification, presentation. This is for the transaction events. Then we have the same thing, assertions about account balances and disclosures at the end of the period. Starting with existence, rights and obligations, completeness, accuracy, valuation, allocation, classification, and presentation. And then we start again. Of the summary of the assertions, now we have classes of transaction events and the related disclosures during the period. Transactions and events that, for the occurrence, we're going to chase the transaction events that have been recorded or disclosed, actually have happened, and such transaction events pertain to the entity. On the account balances related disclosures, we're going to say the assets, liability, and equity interests actually exist. Now, the good thing with this chart is actually going through all the level of assertions with the terminology and tells you which one is related to what. And if one is related to both transaction events or account balances, how is that different between one and the other? Occurrence is on the transaction, existence in the account balances. Rights and obligations related only to account balances. Completeness related to both. Authorization only to the transaction and events. Then we're moving to the next one. Accuracy, valuation, allocation. This is only allocation, as you can remember, accuracy, where in the account balances is accuracy, valuation, and allocation. So for that one, the difference between the transaction events and account balances. Then we have a cutoff, which is only for the transaction events. Then we have classification for both, presentation for both. Again, I find this chart useful because you can see it side by side and the differences between one and the other. Now, gathering the audit information which is used by the auditors in arriving to conclusion on which audit opinion is based. So this is called audit evidence. So any information which is used by the auditor in order to come up with the conclusion, which is he based his audit opinion on the final audit report, that's considered audit evidence. What's the concept of the audit? Nature of the audit evidence. Sufficiency and appropriateness of the audit evidence, how sufficient they are and how appropriate they are to the event. Evaluation of the audit evidence. Again, audit assertions on the transactions and the balance and disclosures, repetition again, occurrence, completeness, accuracy, cutoff, classification, presentation. For the balances, account balances, existence, rights and obligation, completeness, valuation, classification, presentation, which is similar to the management assertions. Those are audit assertions, management assertions, we saw them up here. Now, let's start with the nature of the audit evidence. From where we're going to gather those audit evidence? First, we're going to use the accounting records. Which accounting record? Everything. What the auditors basically doing, they're asking for the entire company file for the year. Once they have that one, they have all the information about everything. Records of the initial entries and the supporting records, general and subsidiary ledgers, journal entries, other adjustment to financials not reflecting the journal entries, worksheets, spreadsheets, supporting cost allocation, computation, reconciliation, disclosures, contracts, So basically, first we're getting the entire database, accounting database of the company. Second, we're getting all the required documents to support the journal entries. Other informations. What other information we can use besides the entire company database plus all these worksheets, spreadsheets, supporting cost allocation, computation, reconciliation, disclosure, contracts. We can use the minutes of the meetings. We can confirmation from the third parties. That's another audit evidence. Now, again, we're relying on the third parties more than we're relying on the client. And then we're comparing what the third party says versus what the client says. If those two match, we're going to have a very good chance to issue unqualified reports. Industry analysis reports. Comparable data about the competitors. From where we're going to get this? Well, first, we can use the Statistic Canada. Second, we can use the artificial intelligence. And that's why artificial intelligence actually comes handy. Control manuals. Information obtained by the auditors from the inquiry, observation, and inspections. All those information, we can use it for the audit evidence. Sufficiency, how sufficient those ones should be, is the measure of the quantity of the audit evidence. Greater risk of mismatch requires higher quantity of the audit evidence. Higher risk of the higher quality audit evidence results in lower quantity of the evidence. So basically, through the nature of the audit evidence, how what's the quality, then we're going to see the quantity. If we have a high risk, then we have higher quantity. If we have a higher quality of the audit evidence, then we need a lower quantity of the lower evidence, audit evidence. Means that if we seeing that all the evidence that we're gathering are directly from the third parties, we're going to ask for less evidence. Appropriateness of audit evidence, we're going to have relevance, how relevant they are, and how reliable they are. Now, the appropriateness is measured by the quality of the audit evidence. So now we have here the quality. Now let's see how we're going to get the quality, relevant and reliability. More reliable, more a high quality. Which are a reliable source? Usually, original documents are a reliable source. Outside, independent source outside of entity is a reliable source. If the internal control in the company is effective, then we can rely on the audit evidence. If the auditor direct personal knowledge is high, then we can rely on the audit evidence. If we have a document, the first documents that happen, then we have the high level quality of the audit evidence. And again, original documents in independent sources. So let's see this. Which one of the following sources of evidence are more reliable? Inquiry of the accounting receivable clerk regarding the accounts receivable balances, or accounts receivable confirmation letter sent to a sample of customers. Which one is more reliable, first one or the second one? What do you say?
Second,
Second, why second is more reliable?
because there's a third party that is going to confirm
Thank
the
you.
um,
Yes, it's not related to the entity. Now, the second one is the physical examination of lumbar inventory performed by the external auditor or physical examination of the inventory performed by internal auditor. Which one is more reliable?
external auditor.
External auditor. Why? Because now we're relying on the direct personal knowledge of the auditor. Not only that, sometimes we trust ourselves rather than the internal auditor. Okay, how are we going to evaluate the audit evidence? Proper evaluation of audit require understanding of the type of the evidence available and relative reliability of the available evidence. And auditor should be true in searching of the evidence and unbiased in evaluation. Now, unbiased, what do you know about, what will be the bias here? What's gonna affect our bias in evaluation of the documents? What do you think? Any guess? What's gonna make us bias if we are in the audit? Give me some ideas. What do you think? Do you understand the bias?
Yes.
When I say teacher, what's the first thing comes in your mind?
Someone who has extensive knowledge about a subject matter.
Okay. Are you unbiased or biased? Your opinion, what you say right now, is it based on bias or is it unbiased?
Maybe a bias.
Of course you are.
Yeah.
Why? Why? Because you expect when you say
Mhm.
teacher, he to have. When you say doctor, what comes to your mind? If I say doctor,
Like an expert
in what?
providing
Health services, right?
yeah. Yeah.
But now you're biased
Yeah.
because you don't know if he actually is professional or not. Same thing with the teacher. You don't know if he has this ability or not.
Mhm.
So in that case, when you see the evidence and when you're doing the evaluation, don't assume when you see the everything in the place, this is actually what is it. Still observe and still try to be, how can I say, cautious. Let's use this word, cautious, about gathering the evidence. Now the procedures. Now the specific act performed by the auditor of gathering evidence about whether specific assertions is met. This is definition for the audit procedures. Those will be the acts performed by the auditor to gather evidence. Now we have to assess the risk assessment procedures, test of the control, and substantive procedures, as we remember from the previous chapter. Now, Now we have a set of the audit procedures which are prepared to test the certain assertions. If which audit assertion is existence, the example of the procedures will be to confirm the accounts receivables. If we're chasing accounts receivables. If the audit assertion is right in obligation, then we're going to inquire management whether the receivables have been actually sold. So now you understand it. So we're going to confirm the accounts receivables. Second, we're going to see, is this accounts receivable actually happen? Is there gonna be, was there sale which create the accounts receivables? Completeness. Now we're gonna check with the agree the total accounts receivable subsidiary ledger to accounts receivable control account. So basically, we're gonna combine all the receivables of all the clients, and we're gonna see the total, is it match the accounts receivable that's sitting in the account receivable balance on the financial statements. Valuation or allocation. We're gonna test the adequacy of the allowance for doubtful accounts. So basically, as you already know, the accounts receivables on the financial statements, again, we're gonna include all the subsidiary ledgers for all the clients minus allowance for doubtful accounts. So now we have to check, is this allowance for doubtful accounts actually adequate in the way they estimate, or the way we're using the estimation and how we presented how we come up with the amount of the allowance for doubtful accounts to the nature of the business and to the nature of the sales this particular company and the pattern of the accounts receivable that happened in this company. Now, let's start again. Inspection of the records and documents. Evidence obtained from the external document is more reliable than evidence obtained from internal documents. Now watch this. We have a source document and we have a journal or ledger. So vouching, true vouching, through the activity vouching, we confirming occurrence. How can we do? We see the journal entry or the ledger, and we're trying to find the source document that triggers that entry. Through that activity, through that, we testing the occurrence. The activity that we're doing is called vouching. Now, if we have the source document and want to see if the source document was actually recorded as a journal entry in the accounting system, we're gonna use activity called tracing. And we're gonna confirm the assertion of completeness. Make sense? Now it's gonna get a little bit more trickier because not only you have to know not only the assertion level, but which is the activity or technique that we're using to confirm that assertion. So inspection of the tangible assets. How are we gonna do that? We're gonna go physical examination of the tangible assets. Observation, through the observation, the process of watching a process or procedure being performed by others. Then inquiry. And conducting inquiry, the auditor should consider the knowledge, objectivity, existence, responsibility, qualification of the viewer to be questioned. Ask clear, concise, or relevant questions. Use open and closed questions appropriately. That's another thing. Now, consider auditor as investigator. You have to ask the right question to get the right information. You cannot use open and close questions. Means open question will be a question that require the person to provide explanation. Closed question is the one that requires the person to answer with yes and no, or simple word. You have to listen actively and efficiently. You have to consider the reaction and responses and ask follow-up questions. So, and you have to evaluate the responses. That's how you perform that inquiry. As you can see, to some extent, the auditor should be very good at communication, definitely. Have the very good communication skills and understand a little bit about maybe psychology and observe the people. Yes. Because technically you suspect by default you suspect something goes wrong. Now the question is, can you get enough evidence that everything is fine? So that's why you have to be careful with the questions, how to use open questions, how to use the closed questions. The closed questions again, and the one that you expect specific answer. One word or yes or no. Open questions, the one that require from the person to express personal opinion. Confirmation. Audit evidence obtained by the auditor as a direct written response to the auditor from the third party. That's a confirmation. The reliability of evidence obtained through the external confirmation may be affected by the facts as the form of confirmation, prior existence of the entity, the nature of the information being confirmed, and independent respondent. Now, if you ask me for a accounts receivables, I have a personal relationship with the client that you're auditing, and the client already contacted me, and I'm aware of that the auditor is gonna contact me and ask you for specific information. Now, whatever you're gonna receive as a confirmation from me, that might affect the confirmation or reliability of the evidence. Now, how you can find that one is the only way you can find that one is by depends who you're chasing. So basically, that's why it's important you to identify which are the clients of the company, also which are the major clients of the company, and what's the relationship of those clients with the company that you're auditing. And if you find something suspicious, that may affect the reliability of the evidence which you are obtaining from those parties. Now the confirmation, which is the party that we're gonna ask, for what we need the confirmation, and which party we should ask for. For the cash balances or for the account balances, we're gonna directly ask the bank or the bank statement directly from the bank. For the accounts receivables, customers. For the company that I was working, I was under audit. The rule was every amount over $500, it has to be confirmed. We have to send the letters for the third party to confirm and send the letter back to the auditor directly to confirm the balance that we saying that the balance is. So some instances, even though we didn't say the balance. Some instances the auditor specifically asked the client to say the amount that he thinks that he owe us, and then they confirming the letter that they received at the client with the amount that we saying or on our system that the client owes us. If those two match, we're perfect. If they don't, then we start chasing what's inventory on consignments. We're gonna ask the consignee. If we have accounts payable, we're gonna ask the vendors. Bonds payable, bond holders. Common shares outstanding. We're gonna check the register. For the insurance coverage, we're gonna talk to the insurance company. Collateral on the loans, we're gonna check with the creditors. As you can see, we're using the third party here as a source of confirmation. Recalculation. What means recalculation? Audit procedures, which is called recalculation. Checking the mathematical accuracy of the documents and records. What that means, when you see the invoice, on the invoice you have a single item price, time the number of units, time the total price. Now we're gonna check, is the single amount price time the number of units equal to the total? If all the totals are correct, GST, which is correct, all that will be direct taxes are actually deducted. Performance. Audit procedure called performance. Auditors, independent exertion of procedures or controls that were originally performed by the company personnel. Then we're going to go to the analytical procedures, which is evaluation of financial information based by the study of plausible relationship among both financial and non-financial data. Again, we can use here easily artificial intelligence to do that for us. Scanning. Judgmental review accounting data to identify significant or unusual item to test. So scanning, we can do the scanning through the artificial intelligence or to the audit software, which is scanning all the information which we already have through the accounting record, through all the database that we already asked the client to provide to us. Vouching. Evaluation of financial information through the source of documentation from the third party. Again, we have the financial information. Now we're tracing to the vouching through the source of the documents. Tracing, using the third party source document to investigate if the transaction has been appropriately recorded in the accounting system. So the vouching is from the journal entry to the source. From the source to the journal entry is called tracing. So now the general guidance for reliability is inspection of tangible assets, reperformance, recalculations of a higher reliability. Inspection of records and documents, confirmation, analytical procedure scanning, lower, a little bit lower, still higher level, but still a little bit low. Observation inquiries, lower level of reliability based on the type of the evidence. So, what's the testing heresy? So let's see this one and try to, after assessing the potential effectiveness of internal control, will test the control be conducted? Answer is always yes, in the most complete manner. Then, if the answer is yes, then we're going to perform tests of controls. Can effective and efficient substantive analytical procedures be performed? If yes, we're going to perform those ones. If no, we're going to perform substantive tests on the details on the transactions and other balances. If yes, again, we're going to perform substantive analytical procedures. In addition to substantive evidence needed, if yes, then we're going to go with this substantive test of the details transactions. If no, we're going to go to the assessment of the results which we have from the documents that we already observed. Now, this is our assurance bucket. Every time when we get the evidence, we're going to put it in this bucket. Now, what's the desired assurance that we want to achieve? If we're doing the risk assessment procedures, we need 20%. To test that control, 30%. To substantive analytical procedures, another 20%. And remaining assurance needed for the test of the details, 30%. So we have 20, 30, 50 plus 20, 70 plus 30, another 100%. That's how we achieve 100% of the evidence. First, we're gonna assess the risk assessment procedures. That's 20%. Then we're gonna test the control of the company. Then we're gonna do substantive analytical procedures. And then with the remaining assurance, need to test the details. That's how we're gonna achieve. So, how are we gonna get those one? On the bottom, as you can see, we have the assertion levels. Test of details. Through the test of details, we confirming rights of obligation, valuation, presentation disclosure, cutoff, accuracy, completeness. To the substantive analytical procedures, we're testing valuation, existence, cutoff, accuracy, and completeness. To the control testing and risk assessment procedures, we're chasing completeness, accuracy, cutoff, existence, valuation. As you can see, from different activities, we're testing different assertions. To some, as you can see, from all the three activities, we can get the valuation. From all those three activities, we can get the cutoff, accuracy, and completeness. But only from one activity we can get presentation disclosure, value, and the rights of obligation. From only two activity, we can get the existence and accuracy. Let's see the audit documentations, the auditor records of the audit procedures performed relevant to the audit and the conclusion reached. Audit documents or the working paper has three functions. To provide the support, to help us in the planning, performance, and supervision of the audit, and to provide the focal point of reviewing work of subordinates and provide basis for the quality review later on when we start assessing the audit documents. And at this point, I'm gonna stop. And I have to ask you for questions. Because the next thing that we're gonna do is we're gonna go with the content of the audit documents. We're gonna go to the permanent files, current files, which one we're keeping, what's the heading, tracking, and all those different documents, risk assessment, substantive procedures, final analytical procedures, all the type, and all the evidence that we can gather in order to express our opinion on the financial statement, misstatement, if there's any. That's the remaining of this chapter, and just quick overview of chapter 6 if you want. chapter 6 will be on the internal control in the financial statement audit. And then there will be other things here on the objectivities. So as you can see now, we start chasing the level of assertions. And which assertions is tested by which audit procedures. So that one is important thing. Those here, those are the audit procedures which we using to confirm the level of assurance. So do I need you to know those procedures, the audit procedures? Yes. At least get some ideas about them and try to understand them. And if you can memorize them, that's even better. But if you cannot memorize them, then always have those slides available for you so you can easily see what kind of audit procedures I have to use in order to confirm the assertion level of, let's say, cutoff. And is this part of the substantive audit procedures? Is it part of the test of the details? What exactly is? Okay, guys, questions again? Any questions for me? Are you guys still there?
Yes, no questions.
No
No
questions?
question, sir.
Okay, then if you don't have a questions, I'm gonna see you next Friday at in the class.
Okay, Prof.
Thank you. See
Thank you,
See you
you.
then.
Professor.
Thank you,
See
Prof.
you
Enjoy
in
your
person
weekend.
next time.
Thank
Yes,
you,
Yeah, see you
Professor.
next week.
Thank
thank you,
Bye.
thank
Thank
you.
you.
Thank you, Prof. Bye.
Bye.
Hello. Hello, Professor.
Hello.
Yes, I emailed you about the recommendation.
Yes. No problem at all. Send me the letters. I'm gonna sign it. Did you send me the letter?
Okay, I'll send you the letter.
Send me the
Because
letter. I'm just gonna sign. If you want, bring it next Friday. I'm gonna just sign it for you.
Okay.
Whatever it's easy for you.
Okay. I'll do that.
Okay. Okay.
Yes. Thank you.
No problem.